Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at how to sell options when implied volatility is low. Firstly, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. Selling options can be a great way to generate income, but when volatility is low, premiums tend to be lower too. So what can you do? Let's take a look at some strategies. Firstly, look for high IV rank. One strategy is to look for assets with high implied volatility rank, or IVR, which indicates a higher level of volatility compared to its historical volatility. By targeting assets with high IVR, you can sell options with higher premiums, increasing your potential profits. Just like a stock, when it comes to volatility, we want to buy low and sell high, or sell high and then buy back lower. One screener that I'd like to run is at barchart.com, and here I'm just filtering for stocks with good option volume, a market cap above 40 billion, and an IV percentile above 50%. So let's take a look at the results. So we can see here we're getting a lot of results for stocks above 50% IV percentile in this case, rather than IV rank. A lot of these have got earnings coming up. So we can see here Target's reporting earnings this week, CrowdStrike next week, Palo Alto this week. So that is one of the trade-offs. You have to decide whether you're willing to accept the earnings risk in exchange for selling that high implied volatility. But that's a scanner that you might like to run to find stocks with a high IV percentile or IV rank. The second thing you can do is sell longer term options. This may sound counterintuitive because of the slower time decay, but when volatility spikes, it affects short-term options the most. So that's our risk. When we're selling options and volatility is really, really low, if it then spikes, we're going to get into some problems. Longer-term trades move slowly and have a much flatter T+0 line. This gives you more time to adjust the trade and also means the trade requires less attention. Now, this chart here that we're looking at is one that I like to share. It's from a day known as the Volpocalypse or Volmageddon. And the main thing to take into account here is this was the level of implied volatility across different expiration dates for the S&P 500 on February 2nd, which was the Friday. Then we got a big vol spike on the Monday. And you can see here the short-term options were impacted the most. Volatility went from about 15.5 on those weekly options up to about 33.5. Whereas if we're out sort of 120 days on the curve, it went from about 15.5 to about 19. So not nearly as big of a deal in terms of our volatility exposure. The other thing I mentioned is our T+0 line. So we can see here the purple line. Normally this is a nice round line. We're getting some issues here with interactive brokers, but you get the idea that it's a very steep line. If the market has a big sell-off, let's say it goes to 635 tomorrow, this particular trade is going to be down around $600 or $700, and that's before any volatility impact. You can see we've got a lot of negative vega here, so we're going to get impacted even worse by the volatility spike. Yes, we're getting great theta on our short-term trade, but we've got a lot of vega and a lot of gamma. Let's take a look at a similar example. We're selling here the 15 delta and about the 11 delta. Instead of the weekly options, let's look at a 120-day condor and look at the difference in that T+0 line. We have to zoom right back out so we can even see the T+0 line. Now, in this case, if the market drops to 635, it barely impacts the trade at all. That vega is a lot lower, our gamma is a lot lower, and the trade-off, of course, is lower theta, but we've got much, much lower risk of a volatility spike hurting us. If you think back to this picture here, this is where we are on the volatility curve. If we get a vol spike, this is about the worst vol spike we ever saw. Didn't really impact those 120 days options very much, but those weekly options got absolutely smashed in terms of volatility. So when volatility is low and there's a risk that it could spike up, really avoid those weekly options. When implied volatility is low, look to sell options on quality blue chip companies. These companies will have a lower chance of suffering a big price drop and subsequent volatility spike. You can also use spreads to limit your risk as well. In low IV environments, spreads can help mitigate risk while still generating income. Consider switching from naked puts to bull put spreads. Let's take a look at an example. In this example, we're selling puts on everyone's favorite company, Nvidia. We're going out to September. We're getting all the way down to the 158 strike with that 15 delta. And for 2 contracts, we're generating about $480 in premium. So pretty healthy return. If we plug that into our cash secured put calculator, we can see we're getting a roughly 17% annualized return if the put expires worthless, and we've got a 14% decrease to our break even. The main problem here is if we change this to 2 contracts, we're risking close to $31,000. That's a lot of money we're tying up in margin. And yes, it's unlikely Nvidia could go to zero, but if it does, we're going to lose $31,000. So one way you can reduce your risk when volatility is low is turn this cash secured put into a spread by buying two out of the money options. We've sacrificed a little bit in premium, but we've completely cut our risk down to $2,500 from $31,000. If we go to our calculator, in this case, we're receiving $238, but we're paying $104. We're still getting $134 in premium. We haven't sacrificed that much. We're still getting a 9.5% annualized return, and our 13% decrease to break even has stayed the same. But in this case, maximum risk is more like about $2,500. So massively cut our risk by turning this into a spread without sacrificing too much in terms of our annualized return. Another strategy you could use is to use indexes or ETFs. They often exhibit consistent liquidity and manageable volatility, even in low volatility environments. And again, if we're using fairly defensive ETFs, they're much less likely to have a big drop than, say, some of these high risk IPO or recent IPO stocks or high volatility stocks. So selling options on indexes and ETFs has a lower risk of extreme price movements. In terms of risk management strategies, low IV conditions require extra vigilance to manage risk effectively. Number one thing you can do, reduce position size. Don't take on too much risk. You should avoid over leveraging. So again, taking on too many positions and too many big positions, and consider using spreads instead of naked options. Diversify your trades as well. So look for some of those lower risk underlyings, stocks and ETFs that are less likely to have those big drops in the event of a vol spike. So in conclusion, selling options in low implied volatility environments can be challenging, but it's far from impossible. You now have a few different ways to adjust your trading in low vol environments. Make sure to check out all the resources in the description below. Reach out anytime with questions, and have a great day.